What's up, guys? Mike Sharp here again. This is Sharp Investing. This is the last in the series of obscure moats, and this is the Warsaw Stock Exchange. It has a Polish name, which I have zero chance of pronouncing correctly, but the symbol is GPW, and let's have a look at it. Okay, so now the moat here is pretty obvious. If you know anything about stock exchanges, they are very entrenched businesses, very hard to dislodge, very hard to compete with. And if you look at any sort of small, medium-sized country, there's usually only one major exchange, and basically they act as somewhat of a local monopoly. It would make very little sense to try and compete with a company like the Warsaw Stock Exchange because all the big companies are already listed there. So I think that if you look back in 20 years, this company has a very high chance of still being around. I would say it's almost guaranteed, unless you think that, Russia's going to invade Poland and destroy the country, or you think that communism might have a revival and all the the evil capitalist systems will be put to death like stock markets. I personally don't think either of those things is going to happen, so I think the risk here is pretty low. There are some risks, though. I'll get into those later. Now, the thesis here is pretty simple. I mean, if you look at the company historically, the growth hasn't been great. It's about 5% over the long term. But at the prices paid right now, there's very little downside. They're trading, well below the actual the price that they went public at a number of years ago, and the stock has been pretty stagnant since then. And I don't think that there's much chance of a permanent downside here, because the valuation is just too low. And being the business that they are, I very highly doubt that revenue and earnings will collapse for any reason over the long term. They might have a bad year or two here if there's a recession, trading volumes go down. If trading volumes go down and people don't want to buy stocks, then obviously their revenue will go down. But unless there's a 10-year or some kind of permanent recession, then I would say the revenues and earnings will bounce back. Right now, they're paying about a 7% dividend, which is pretty strong. And so basically you get paid 7% just to sit and wait for any potential upside here. So that's a pretty good situation, low downside. And then the upside would be that they've just released a new business plan, which is encouraging because the revenues have kind of stagnated over the last few years, but they're aiming at growing revenue by 46% over the next 4 years. And being a high margin business with high incremental margins on growth, that could turn into a fair amount of profitability. This new business plan involves adding some new products, more derivatives and ETFs and things like that, and also adding more data services for professionals. And these are really high margin products. So those could potentially add a fair amount to the bottom line. The other part of the thesis is, kind of around Poland. I mean, it's been it's actually been the fastest growing European economy over the last 30 years. I guess that's not saying much, but they have gone from being a developing nation. They've moved up, and they're no longer considered developing. I think they're considered developed now. So some of the old thinking about Poland might be out of date at this point. One other thing that is true in Poland is that people don't have very much of their net worth in stocks, right? Last I read, it was about 4%. And I think that if you look at some of these more developed countries, developed financial markets like the US or even in Europe, the US has where people have 35% of their net worth in equities, and in Europe it kind of averages about 25%. So even if people got more, well, not even if, but if people got more used to having their wealth in equities as opposed to, term deposits and things like that, this could really spike the revenue of the company as people put more of their retirement savings into stocks. So one of the other things here is that they have a very low valuation compared to the peers, right? Like their EV to EBITDA is less than 8. They have a high dividend, which is unusual with these types of stocks, and their PE is in the low end of the range here. There's a reason for these cheap valuations, is because the growth hasn't been that good over the last few years. So the market is basically saying we don't believe that there's any growth coming, and that's why you need to pay us more to invest in this company. But I think that there will be at least some moderate growth coming in the next few years. So I think that a revaluation is possible here. One of the last bit to the thesis here, the bull thesis, is that this is kind of a bonus. Now, if there's a ceasefire in Ukraine, I think that the Polish stock market, or most of the stocks in Poland, could revalue a bit higher, just because right now there's a worry that the war could spill over into Poland, or that Russia may invade Poland via Belarus. I don't believe that personally, but I think that fear is weighing on Polish stocks right now. There's a lot of cheap stuff. I actually own another company called Moats, which is also very cheap. Well, it's well priced, I would say, for what you're getting. But across the board, it looks like there's a lot of deals in Poland. So that's a bonus if there's some kind of ceasefire at some point. Maybe that will help. I should actually mention here that this is Sven Lorenz's idea. He runs a newsletter called Undervalued Shares, and I would just like to plug that for a second. He's got he gives you, I think, 10 stocks each year, and I think it's very cheap. It's like $80 US for a year, and I find the write-ups very interesting, very entertaining, and they're really well delivered and professional. So if you're interested in finding some stocks that you may not have heard about before, he's a great source for that. Okay, so let's get on with this and the financials. Just quickly looking over this, I'll just do really high level. Revenue is growing at over 5% for the last number of years, but they're aiming at 46%, like I said, over the next 4 years. So we could see an improvement here. Historically, it hasn't been a huge grower, though. And so again, that's why I think the stock is the price that it's at, or the valuation that it's at. In terms of EBITDA, those are down in 2022 at 46%, but this is a very, very high margin business. And I would expect, like basically their plan says they want to get back to 50% quite quickly in terms of EBITDA margin. And I think they're going to be able to do that. Now, this drop recently was due to inflation on some of the cost side, but they should be able to right that over time. Return on equity, this is a really important metric when you're looking at the company's ability to reinvest capital. So that's at about 16% over the long term, which is a great return. And if I do a quick valuation here, so their goal is to get back to an average of 215 million EBITDA in EBITDA, but that was about what they made 2 years ago. So there's not really any growth there, but reading through the lines here, it looks like they're actually targeting about 250 million in EBITDA by the end of this plan, which is 2027, on 500 million of revenue. So if we get to that 250 million in EBITDA, take a 10 times multiple, you could be at a market cap of 2.5 billion, which is 57% higher from here. Now, I actually think if they do get there, the company valuation could re-rate from 10 to something higher, like a 15 or a 20, which is more normal for an exchange stock. And so if we did that, let's say we did 15 times, that would put the market cap at 3.75 billion, which is 135% up from where we are right now in 2023. So that would be a pretty good return over 3.5 years. Upside, I would say maybe is 5 billion. So that would be about 250 million in EBITDA times 20. Lastly, I'll talk about the risks real quick. Basically, the risk is that the one of the risks is that the revenue growth doesn't materialize. They continue to sort of just sputter along here, and they end up with flat revenue. If that happens, then yeah, you still get your dividend, but there's a real chance that the real risk here is the currency devaluation. So their inflation rate has been pretty high. So if it stays higher than, let's say, the U.S. rate, what would happen is the currency will devalue versus the U.S. dollar, and you'll end up with maybe a stock that's flat, same price in a few years, but the currency would have fallen by 10-20% versus your home currency. So I would say currency risk is the sort of the major one that I'm thinking of. The other risk could be, like I said, Russia. Maybe I'm wrong, and there is a war on Polish soil, and that would be pretty much a disaster for Polish stocks. You've seen what happened to Ukrainian stocks. But my thinking is, like, I really don't believe that Russia wants a war with anybody else at this point, especially a NATO nation. I mean, they seem to be fairly bogged down in Ukraine as it is, and I don't think that it makes a lot of sense to start a war on another front. But that's just me. I'm not a political scientist. I don't really know what's going on there, but just logically, you would expect maybe they don't want another war. Anyway, that is the Warsaw Stock Exchange. I hope you got something from that. If you have any thoughts on it, please let me know, and I will see you in the next video.